It's October 23rd on Wednesday. Ernest wants me to tell everybody the dates that we're recording because we're so excited about our presentation on October 29th at 7 p.m. The presentation is called Quality Investing for the Long Run. Ernest and I will be presenting a Baskin strategy on how we invest for clients, our thoughts on the current market, presenting some ideas for you to take a look at. And so we think it's going to be a great time out. It's free registration on our website at baskinwealth.com. We'll also be linking the presentation to the show notes. We'll be recording the presentation and sharing it with everybody after on our website as well. We'll be sharing it on our YouTube channel. So thank you everybody for joining us. This is the podcast. Ernest, how you doing?
As good as I can be.
Very good. We want to talk about a number of companies that have reported earnings. Q3 earnings started off, but because today is Wednesday, October 23rd, today was the day that the Bank of Canada announced
Today's Wednesday.
Did I say Wednesday?
I said Tuesday.
I have no idea what I'm saying. It's announced a 50 basis point cut. That's 0.5% for those that don't know what basis point means. I think it's the third or fourth cut by the Bank of Canada this year. Those that have long memories will remember the Bank of Canada started raising interest rates in 2022, continued to raise interest rates in 2023, and now starting to cut interest rates. They're cutting interest rates. Why? Because inflation has come down to the pre-pandemic levels. Actually, I think the latest inflation number in Canada was about 1.6%. Hopefully I'm right there. As well in the U.S., inflation is coming down. The United States also did a 50 basis point cut a month ago, and the expectation is for Bank of Canada to keep cutting rates over the next 6 to 12 months. This is good news, of course, if you're looking to get a variable rate mortgage, if you have a line of credit. It's excellent. If you're one of those people that took advantage of the high rates to buy GICs for 1 or 2 years, you may have those GICs now or money market funds coming due. And of course, reinvesting those GICs at today's rates aren't so attractive. So there's implications and winners and losers for everybody. So Ernest, your take on the Bank of Canada rate cuts announcement today on Wednesday.
Yeah, so as you noted, the Bank of Canada cut interest rates by 50 bips to where the policy rate today is 3.75%. Mm-hmm. It peaked in 2023 at about 5%, I believe.
Yeah.
And again, like as you noted, it will benefit variable rate borrowers and people who have those types of debt. I think the thing that is probably going to gain more attention over time is what happens to the long bonds. And by that, I mean the yields on 5 or 10 years, 10-year bonds.
Yeah, so the yields on bonds where you buy them that you would hold to maturity for 5 years, right? Unlike a GIC where you buy and hold it for 1 year, it renews. There are bonds that you can buy that you get a locked-in rate for 5, 10, 20, 30 years.
And I think the reason that this matters is because most bonds and fixed mortgage rates are really based around the long bonds. Mm-hmm. And so to the extent that 5-year bond rates are not falling, upon the boost to the economy may not be as much as the Bank of Canada is hoping, mm-hmm. because mortgage rates aren't coming down. So
let's talk about this phenomenon. You're seeing, of course, interest rates at the short end. That's interest rates that are based on few months to 1 year really coming down, but the longer end not coming down. So what is creating this phenomenon where interest rates aren't necessarily moving in the same direction across different maturities?
Well, I think there's a variety of explanations for this. I think the positive way to look at this is that the bond market is saying that to the extent that there are sharp rate cuts, it'll prevent Canada and the United States from entering a deep recession. Mm-hmm. So the outlook for the economy in 5 or 10 years is better than it was before the rate cuts.
Absolutely.
So that's one way of looking at it.
That's a great way of thinking about it. Because we're cutting interest rates today, many people were worried that the US and Canada was going to enter into this hard landing or even a soft landing and potential recession. But because now the central banks are acting so quickly, cutting rates, which will help lines of credits for businesses and for personal and maybe stimulate the economy, then the next 3 to 5 years, the outlook looks better than it is today.
I guess if you wanted to be a little bit more skeptical about these kinds of things, you might note that the rising 5 and 10 year indicates that inflation might pick up again.
That's right. We have a presidential election. There's one, and that's coming up in 10 days. There's one candidate who wants to slap on tariffs.
Yeah.
That could cause inflation. There's one candidate who wants to raise taxes. That could cause a slowdown in the economy. We don't know. And of course, we'll get into election in a second. Another way of putting it is, as you said, it's possible that the economy is just doing too great right now. So many people talked about this hard landing, this soft landing, as interest rates got cut from, Ernest mentioned, 5% to 3.75%. Many people thought as they cut interest rates and as inflation was so high, we would have entered into a recession by now. And the central banks, by cutting rates, by doing whatever they did, they were able to engineer a no landing scenario, a scenario where everything turned out okay. And as a result, if everything turns out okay, there's no reason for longer bonds to go back to 2%. Sticking around 4 to 5% probably is a very reasonable place for 5 to 10 year money to sit at.
That's well said.
Yeah. Okay. Thank you.
And yeah, I would say we don't really factor in these kinds of things too much into our investment decision process. Like they're things that we watch and we pay attention to. But at the end of the day, like what we care about is whether the companies are running their businesses at a micro level.
Yes.
And that's what, hopefully we've talked about this enough times on the podcast to hammer that in.
I'm hopeful, Ernest, so I look at the 5-year Canada bond today. I think the yield is 2.97%. I'm hopeful that the investments that we make will earn more than 2.97% a year for the next 5 years. The 10-year U.S. bond is 4.25 today. I'm hopeful the investments we make more for our clients than 4.25% a year for the next 10 years. So those are your benchmarks for the risk-free return before taxes, inflation, and fees. So that's it tells you what your goal is to try to achieve to do better. I think those are very low benchmarks, but I am happy, of course, that we are getting some kind of yield on fixed income, right? We're buying bonds today for clients that pay around 4 to 4.5%. Doesn't sound so terrific, but certainly way better than we were getting 4 or 5 years ago when we were buying bonds that only paid 2%.
And very attractive on an inflation-adjusted basis as well.
Yes, of course. Right. So I hope you're able to follow that conversation. I think Ernest is exactly right. We try not to let that factor into our investment decision, and every little tick in the interest rate movements for bonds doesn't really affect how we invest. Oh, bond yields have gone up a little bit. Let's sell some stocks. Oh, bond yields are going down. Let's buy more stocks. We don't really think about that, as we mentioned a million times, and Ernest just said, we want to just partner with good management teams that hopefully are investing to earn double-digit returns, not 3% or 4%.
Yep.
Okay. So, Ernest, in 10 days, there'll be hopefully a new president. Hopefully that there won't be any contesting. The presidential election won't be contested. It will be a definitive done deal, and we'll find out what happens. Obviously, you hear the terms, this unprecedented, the most uncertain times, which may be fair. I'm never going to discount someone's opinion or someone's fears or worries. Obviously, we're at a crossroads here with two very, very divided U.S. for sure. We've looked and talked about this many times on the podcast and to our clients. It really doesn't matter who the president is for the stock market long term. I think the goal of both presidents, whoever wins, will be hopefully to grow the economy, and businesses should do well under most environments. Obviously, the best scenario that we've read is if there's gridlock in the president and the House so that really nothing can get accomplished, so that no one can push through maybe their crazy ideas too much in one direction or the other. But that will remain to be seen. Ernest, if you knew the future, if you knew who was going to be president today, and you knew the House and the Congress, what was going to happen, would you change anything with our portfolios?
No, I wouldn't. And I think the best quote that I've heard about the upcoming election is from Larry Fink, who is the CEO of BlackRock, the world's largest asset management firm. And he said he's tired of hearing that this is the biggest election in your lifetime and that this is going to change everything about and he's talking obviously about the stock market and the financial markets, right? Obviously, it matters on the societal level who is the president and the kinds of policies that they're proposing and implementing. But the way that Fink puts it, the reality is by the time it's over, then it doesn't matter. Yeah. The financial markets are going to continue to do what they do. Yeah. Like companies are going to continue to go out and make money, and you're going
to go with your family on the weekend to Costco. Yeah, because you got to eat. Yeah, you may go see a movie. You may order pizza from Domino's. Life is going to go on. Yeah, I don't think the one president has the ability to make that much damage or progress in any economy. Of course, there are some precedents, of course, in the Great Depression, but we're hopeful that we'll stay the course. We have seen, the results under a Republican president, which was Trump, as well as Biden over the last 8 years. Stock market's done quite well. Yeah. And there's been a lot of crazy stuff that's happened. We talked about it on the last podcast. So it's earnings that matter, stupid, as everybody says, and as long as earnings on the companies in the S&P 500 continue to grow and inflation and interest rates are under control, hopefully markets will have strong performances going forward.
Yeah, and I think the important point to really hammer down is that it's not that we don't have views on who should be the president or the various policy proposals that they have. Yeah. It's that as an investor, you shouldn't overthink the impact that these kinds of things have on your returns, right? Like, I think the worst thing to say would be, oh, if this candidate or the candidate I don't like gets elected, it's going to be a disaster. Yeah. And everything is going to go to hell, right? I think that history has shown that that just isn't the way to invest.
Yeah, we're talking about investments only, by the way. Yeah. Other aspects, we'll definitely not get into. So anything else you want to cover there?
No, I think we covered it well.
Yeah, so we'll see what happens, and hopefully there'll be much less volatility this time around. So we want to get to a number of companies. I think one of the things that Ernest and I want to make clear is earnings season is very volatile. Companies will report earnings which on paper look amazing, and sometimes their stocks will go down. Companies will report lousy earnings, miss expectations, their stocks will go up. And sometimes they'll report good, it will go up, and bad, it will go down. It's hard to know. And it's really about what is priced in and what is being said about the future, right? Because the day the company reports its earnings, it's reporting old news. Just because a company reports great earnings, that's great earnings to a few weeks ago. And things can change really quickly, right? We can have a pandemic. We can have anything that can happen. So predicting the future, even for the people running these multi-billion or even trillion-dollar companies, is near impossible. What we're looking for our companies, we don't want to react to the big changes or swings in stock prices unless it's to our advantage. But we're not going to let price dictate our behavior, hopefully. Right? It's really about what are the companies saying, what are they doing, and can we see a reasonable results. So the first company we want to talk about is CoStar. Yep. Right? So CoStar we've done a podcast on the company. It's a commercial real estate information provider, as well as owning a number of platforms. And Ernest will reiterate the thesis again. This stock has not worked for our clients yet.
Yeah.
right? We've owned it for a few years. It just hasn't been a performer. The fundamentals have been fine. Actually, the fundamentals have been very good. And the company has made, after we bought it, the company has made an investment in a new line of business that is still yet to bear fruit. And that's something that we didn't see when we initially bought the stock, but we trusted the management team that this will lead to lots of fruit going forward. And it's certainly something that the management has done before, where they've built businesses essentially from the ground up. So Ernest, you know a lot about CoStar. You take all the blame for the stock not doing well so far. Hopefully it will do better going forward. But why don't you talk about CoStar and give an update on it?
Yeah, and I think this is really why investing is hard, right? It's because you're balancing a variety of factors that, like, on the one hand, you want to maintain a long-term view of the business and not overreact to any like data points in the short term. But then on the other hand, you also want to be realistic about the things that are happening with the business. And so that's where CoStar kind of is today.
And you want to make money.
Yes.
Yeah.
So that's where we are with CoStar today, where the core business of CoStar, which is a data subscription that they sell to real estate agents and the real estate community about like all the information that they have on the commercial real estate industry, that business together with the marketplace business, which is apartments.com, those businesses are performing very well.
Yeah.
And that's especially impressive given where we are kind of in the commercial real estate cycle.
That's right. So CoStar sells information as well as makes money on listings in commercial real estate, which is probably in the worst market since the Great Financial Crisis. Maybe even worse than the Great Financial Crisis.
So those businesses are all doing very well. They're growing double digits. Margins are growing. Like the subscribers are staying. They're adding new customers every day. Those businesses are going well. The real issue for CoStar is with regards to their investment in homes.com. So for those who didn't listen to the prior podcast, homes.com is basically like Zillow in the US, where it's a website. You can go on and if you want to buy or sell your house, you can go on homes.com. You can search by the neighborhood.
Canadians have a similar business, Realtor
or House Sigma or those kinds of sites. And CoStar has invested a lot of money into homes.com, including like Super Bowl ads. They've spent like $1 billion on marketing. Like they've done a lot. They've done a lot for this business.
And so that $1 billion is doing ads as well as sales, as well as SEO, Google search engine optimization, buying keywords.
So they launched homes.com in February of 2024. So about 7 months ago.
Around the Super Bowl.
And I think it gained some initial traction, but every indication is that it's slowing down. And the management admits it, right? They in the most recent quarter, they said that they're going to miss their revenue expectation for homes.com because things aren't going as well as they hoped, right? I think the management story for homes.com is, like we're 7 months early into like a decades-long investment. So don't overreact and we're going to figure this out, right? But the reality for homes.com is that it's a challenging business model because there are already entrenched players in the marketplace, like Zillow, Realtor.com. These are brands that people already are used to going to when looking for a house. And that's what homes.com is facing up against. And so I think the market has been really, I would say, they've been looking for indications about how far CoStar wants to go with this thing, right? Do they really want to, like, how much money are they willing to lose to kind of chase this opportunity? And so I think the management, like they didn't really, they said, we're still interested in this opportunity. We still want to do it, but maybe we're going to take the foot off the gas a little bit next year with regards to marketing. And that's what we're seeing with CoStar.
Or maybe even smarter marketing. And they're looking to hire more dedicated sales agents to go after real estate agents So there's a lot of money to be spent because they must advertise it. They want to get you and I to start using homes.com website to search for houses, or as many people do, as well as get the agents to also use it and to encourage to be on there to encourage their clientele to use it, right? So.
And I think what everybody's waiting for me to say is, well, are we going to sell or buy more of the stock?
Yeah, what are we going to do with the stock? Because the stock is not performed as well as we would expect. But it all comes down to fundamentals. And do we trust management that they're going to do the right thing, whether homes.com works out or doesn't work out? And also, are we just being impatient with the where we are in the cycle right now? Rates are high. We know we're hopeful they're going to start to come down. Maybe they won't, because we talked about the potential for maybe the U.S. economy doing better than we thought. But that can also be a good thing if the U.S. economy does better, right? Commercial real estate could start to pick up. So your take, your 2 cents. Are we going to give CoStar the benefit of the doubt?
Yeah, I'm certainly inclined to do so at this stage because, number one, CoStar has a great track record of doing these kinds of things. Even from the time they started the initial CoStar data business to the way that they've built up apartments.com, right? Like, they have a great track record in building up these real estate related businesses, and they've been very successful in almost all of the initiatives that they've done. So the track record would suggest that you should at least give them a little bit of chance for them to prove out the thesis before giving up. I think another thing is that they have a very strong balance sheet. They have $4 billion of cash. And
that's about 15% or so of the market cap is just in cash. Yeah.
And like, it's not all bad news for homes.com as well. Like, the marketing spend that they've had has clearly raised the brand awareness of the brand of homes.com among consumers. They like the agents, like, that they're going to come out with a better selling strategy to the agents. And there are regulatory changes that, like the antitrust lawsuit against the Real Estate Association, which they're well positioned.
And what does the company say about the trajectory or the improvement of results in homes.com? When do they expect to see? Because clearly, I don't know how you can judge whether something is good or not after 7 months, right? Especially when you have to spend a lot upfront on advertising and getting the word out. And admittedly, they've made some mistakes in the way they positioned homes.com at the beginning.
Yeah, so they say that they haven't given formal guidance on terms of like when they expect us to scale up or when they expect to reach $1 billion of sales or anything like that. But I do think that they have at least hinted that they're going to be more careful towards ensuring that the marketing spend that they're doing is going to drive long-term profitability at the business.
Mm-hmm. And of course, CoStar can afford to spend money on this project because its other business lines are doing quite well.
Yeah.
And hopefully when the commercial lines inflect, when the cycle inflects, those lines of businesses which are doing fine now will do great. And the question is, if we like the company and we believe in the management team, I'm sure someone would say, well, why don't you wait? Get out. Let's get out and wait till it's clear that everything is improved. Well, the stock won't be at $72 when you want to get back in. You'll have missed it because the market will figure it out and it will run up to $100 a share. And so we've been there. We've done that. Trust me. I have gone on to the sidelines waiting for the things to improve. And they didn't improve. The market figured it out that it would improve well before it improved, and then you missed the stock completely. So I don't want to do that again. I've made that mistake multiple times where I've either gotten impatient with the stock price performance, even though the fundamentals were doing well, or you and I talked about it today. A company investing in a pet project, you feel like they're throwing money out down the toilet, but you're forgetting that the other parts of his business are so beautiful that they can afford to do these things.
No, we can even name the company.
What is it? Facebook.
Facebook, right? So, no, I think there is a very clear parallel between CoStar today and what Facebook, or Meta, as it's called, was in 2022, where in 2022, the ad market was slowing down. Meta was investing billions of dollars into this virtual reality project and even changed the company name.
Yeah.
Everybody didn't think it was going to work out.
Yeah.
And the stock tanked,
Yeah.
right? And it turned out that, like it didn't end up turning into anything,
Yeah.
the Reality Labs investment.
Nope.
But stock has done very well since then.
That's
as
right.
the ad market turned. And that's where we are with, I think that's where we are with CoStar today, where you have a core commercial real estate business that is probably at an inflection point. Like things are probably going to improve from here. They're investing a lot of money into homes.com, which, may or may not work out. We'll see what happens. But then the valuation is cheaper than it's been for a high quality business than it's been for a long time.
Yeah.
So I don't know if it's going to perform the same way as Facebook did off the 2022 bottom.
Yeah.
But there is a parallel to be made.
All right, so moving on. So CoStar was an example of a company that reported bad earnings where the stock fell. Let's talk about a company that reported bad earnings where the stock went didn't go down so much, actually even went up. And when I say bad earnings, it's not necessarily like, oh my God, end of the world. It's just maybe the earnings didn't miss expectations. Still growing, still decent results. You can find a lot of awesome metrics in it. Because we're not technically, we're really not buying lousy businesses, right? We're buying businesses sometimes that may have a tough quarter or or in the bad part of a cycle. So TFI International is a company that just reported earnings. I think they missed expectations by a great deal. Yet the stock on earnings day went up.
Yep. So TFI International, I think is one of the stocks we've owned for the longest time.
Very long time, yeah. I started buying at Ernest as a convertible debenture, very attractive terms at the time. It converted into stock, and we kept it.
Yep.
So clients who've held it since that period of time have done very, very well.
So the very big picture for TFI, for those who are not who haven't followed the name,
and we have a podcast, by the way, on TFI as well. Yeah.
So the very big picture is that they made a gigantic investment in 2021. Into a company called basically it's what they call a less than truckload carrier in the US from UPS. They bought this company. They call it T-Force Freight now. And the thesis was that they were buying it from UPS, who didn't run it very well. And they were going to fix it up and it was going to be great, right? It's been now 4 years, 3-4 years since they bought it. And they've pushed back their expectations for T-Force Freight several times. Yeah. So it's gone the turnaround has been tougher than they expected. And there's some of that is macro, where the trucking cycle today is not very strong because of the retail sales are very weak and industrial activity is kind of weak and there's oversupply in the industry. But the big issue is the culture, right? Like, the UPS guys simply didn't have a culture of making money and running the business in an efficient way.
Yeah.
And it's been hard for TFI to fix that. But since they did the deal, the stock has still been going up.
Yeah. I mean, the deal has not worked out great, right? It's still been additive to their earnings, right? It hasn't been a destroyer of capital.
Yeah.
Yeah.
And I think there is a lesson in there where if things are like, if you have a business where the price that you paid was low enough, it covers over a wide variety of sins that could happen and execution issues that may occur going forward.
I have never integrated a less than truckload business, so I wouldn't know how hard it could be, but I can imagine it can't be easy. And of course, you mentioned the cycle has been very tough for the trucking and freight industry right now. Just one where we saw such a huge boom during late 2020 on all through 2021, which ended very badly, of course, as people just stopped buying all the things that they needed to buy. And that may be corrected as interest rates go down and spur some more retail sales. We don't know, but with high inflation, people are just buying fewer things. That's the bottom line. One of the things that struck out to us was how tremendous, how much free cash flow TFI was able to generate in really one of the worst cycles it's seen in trucking. Still immensely profitable, but disappointing is that it lowered its guidance. But this was one where everybody knew it was going to lower its guidance, but not everybody knew how much free cash flow TFI can produce in such a bad part of the cycle. So when the cycles always turn. One can imagine how much free cash flow TFI is going to generate, and I would assume in the next 6 to 12 months, given how it's good its balance sheet is, might be able to make some acquisitions too.
And that was the second part that was kind of relevant in the call, which is that there has been expectations that after they bought Daseke, which we've talked about before, that they were going to do a separation of their truckload business, separate into two companies. And one is the asset light good stuff, and one is the low returning bad stuff, right? They now don't think that they're going to be able to do this until 26 or 27, until the T-Force Freight business is, until things have improved a little bit for that business, and maybe for them to make another acquisition so that both companies are a bit bigger.
That's right. And also, you probably don't want to separate the two companies in a down cycle. It's just not good for marketing, not good for business, recruiting talent. So, all right. So we're moving on now to companies that reported great results, but stocks went in different directions. Let's start with a company that reported amazing results, a company we've owned for a long time, and yet the stock fell, and that's Moody's.
Yep.
Moody's we started buying, oh my God, probably right after the great financial crisis, a few years after it. If those who remember in the great financial crisis, Moody's was one of the bad actors.
Yep.
Rating a lot of these mortgages that were repurposed as AAA. And then, of course, we saw in 2008, 2009, all these AAA mortgages went to zero, pretty much. So Moody's was fined a lot of money by the U.S. government, really had a lot of issues in it. The stock had fallen dramatically. Moody's, of course, it's the biggest part of its business is credit ratings. So any bond issued by any corporation, you generally will get a credit rating by Moody's or its competitor, S&P Global. And that gives you a benchmark if you want to buy it or not, right? If it's investment grade or junk, it's very helpful for investment managers like us. So when the stock had fallen a lot, we got interested in it, but we kind of waited till things were better, Ernest, before buying the stock. We missed a double on that. We should have bought it when things were lousy. But luckily, we purchased the stock a number of years ago, so it's done well on it. Moody's had one of the best quarters I've ever seen it report. Just amazing results, yet the stock fell. Why don't you give some more color on Moody's?
Well, the stock fell on earnings, but it's still doing pretty well overall.
Fundamentals are credible.
No, year to date.
Yeah, of course.
Yeah. So I think the key for Moody's is, so there's a couple things to break down for Moody's. The first is kind of where we are in the credit cycle, right? Moody's generally benefits when companies are issuing a lot of bonds, right? And so if we go back a year or even 2 years, interest rates were going up.
Yeah.
No one was issuing bonds.
Nope.
Everybody had already issued a lot of bonds at record low interest rates in 2021. And so certain portions of the market, like especially high yield and those kinds of things, they essentially went to zero.
Yeah.
And I think the strength of Moody's business model is that they make money when the bond is being issued, but then they also earn like a recurring fee to monitor the rating. Right?
Yes.
And so, they remain profitable even.
It's a volume business. The more volume, the more money Moody's is going to make.
Yep.
And they make high margins on those credit ratings.
Yep.
Right. It may be someone like yourself as an analyst, spending time on that company's bond, giving it a rating, monitoring it. But it's people and a little bit of technology spend. It's not that expensive for Moody's to provide these ratings. So, and it charges a nice amount of money to companies for these credit ratings.
And so what we've seen over the last year or two is that as interest rates have started to come down, and as and more importantly, as spreads have compressed. So spreads meaning like the rate that companies are paying on interest relative to government bonds.
Okay.
As that has fallen, companies are more interested in issuing debt.
Yeah.
And we've seen that.
And those spreads fall in good times.
Yeah.
Which we are now, right? No denying when the market's near record highs, those are good times. Company spreads between government and corporate bonds shrink because people are not fearing that corporations are going to go bankrupt. So they think these are good times, so good times to issue debt. Go ahead.
And so in the first half of the year, what we saw was that high yield bonds came back. So junk bond, like lower quality issuers came back. But investment grade bond issuance was still kind of weak because companies were still a little bit cautious about what was going on. What we're seeing now is that everybody's back to the party, so to speak, right? Everybody is like people are borrowing money.
Yep.
They want to refinance their debt. They want to do acquisitions, right? And so overall issuance volume for Moody's in the quarter was up 51% year over year.
Wow.
And the reason the stock is down is because when things are going well, people want to ask, well, is there any more juice to this?
Yes.
Like, is this the best it can be?
Probably it will be.
And I think it's a fair question to ask, right? Because when things are bad, then you have upside. And when things are good, then you have downside.
Yes.
But Moody's thinks that there is still room for upside because, number one, private equity firms still have a lot of cash on their balance sheet, right? And as interest rates continue to fall, they will be forced to go out and make acquisitions and issue debt.
I read somewhere $9 or $10 trillion of money on private equity balance sheets ready to be put to work.
Yep.
That's a lot.
Yep.
And probably growing. That's probably an old number. Yeah.
Number two is that if you look at M&A activity overall and issuance level, like relative to historical levels, they're up significantly over 2023, but they are still kind of in line with historical averages.
Okay.
So it's not that people are truly going out and partying, right? If that makes sense. It's simply a rebound from like historically low levels to back to a more normalized level. So to the extent that the economy is good, there is more opportunities for upside growth. Mm-hmm. And then further down the road, there is still, I think it's $4 trillion of debt over the next 4 years that is going to have to be refinanced.
$4 trillion of debt coming due, issued by corporations years ago when rates are low, that's going to come due, that presumably they'll reissue.
Yep.
And of course, as interest rates come down on the low end, that may encourage companies to borrow money short for 2 to 3 years or 5 years. So that could unleash a whole number of bonds that have to be rated.
Yep.
We'll have to do a full podcast at some point on Moody's because there's a lot more to talk about. It also has a information technology business, a recurring revenue business, selling lots of data for a lot of different financial services and insurance and credit rating reasons, and very successful part of its business as well. This is one of the truly best businesses that we have ever owned. And even if the growth slows from here, we still feel very confident about its business model going forward.
Yep.
And then the company that reported great earnings and the stock price did great is Netflix. I like how this theme all came together. So Netflix reported earnings last week. I think the stock went up 11%, which is massive for a multi-$100-billion company to go up that much in one day. Ernest, why did Netflix go up so much? Why are people watching so much Netflix? Well, I'll turn over to you in a second, but I read somewhere that paid members are watching 2 hours a day of Netflix.
Yes.
Do you watch 2 hours a day on Netflix?
No, definitely not.
No, I don't either. I don't even know if I can find, I did watch that Lyle and Eric Menendez thing. Did you?
No, I have no idea what you're
talking about. You
talking
know what I'm talking about? Monsters, pretty cool. Check it out. I like watching a lot of the documentaries on it. Have you ever watched those Untold documentaries, the sports ones?
I've watched a couple of them.
Yeah, they're really good. I'm not right now. I'm watching. We're moving on to such a crazy tangent, but I'm watching The Penguin. The Batman series on. I guess HBO. Excellent. Check it out. Okay, Netflix.
Sounds better than The Joker too.
Oh, When my son told me that the second Joker movie was a musical, I'm like, what? And apparently it's not doing very well, right?
I think it was not only is it not doing well,
Yeah.
I think critics are, I didn't watch it, but critics are saying it's like objectively a terrible movie. So, like, as you said, we're getting way off topic here, but I remember the first Joker,
Yeah.
where I was invited by Cineplex's management to go to a special screening of the Joker.
Okay.
And it was like the greatest movie, one of the best movies in that genre that I've ever watched.
It was really good. I really enjoyed it. Yeah. Joaquin
But
Phoenix is incredible in it.
I'm very disappointed.
Yeah, the
with how it's
second one.
going. But anyways,
apparently they're not making a sequel. The director of the second movie is done after this. Okay, so Netflix.
Anyways,
Yeah,
Netflix.
yeah.
Story about Netflix is not too different from what has been going on for the last year.
Yeah.
Which is that the advertising tier and the crackdown on password sharing continues to drive net subscriber growth. So in essence, I think this quarter subscribers was stronger than expected. Some of that was because they cut out the basic tier in the US.
Okay.
So basically now you have to choose between, do I watch ads or do I pay less and watch ads?
Is
or
it confusing now to sign up for Netflix? Or how many different tiers are there?
No, so there's ad,
Okay.
there's standard, and there's premium.
Okay.
Right. So just 3 tiers.
3 tiers. Okay.
And that was actually one of the things that the management noted about getting rid of the basic tier, is that they didn't want too many choices where consumers get confused about what exists.
Yeah.
And so that's the good part, is that people are continuing to sign up for Netflix, especially after they've been cut off for whatever reason, and they're signing up and they're watching Netflix. I think the thing that people are a little bit cautious about is that overall engagement for Netflix, so the total hours viewed on Netflix, is not growing.
Yeah.
And what this means is that those who are cut off from Netflix are simply signing up again.
Yeah.
And then they're watching Netflix like they used to, but they're not watching more. Nobody is watching more Netflix than they did before.
We want them to watch more than 2 hours a day of Netflix?
Yeah. And that's the worry that the market has over Netflix stock, in that these are one-time tricks that they pulled out to drive revenues, but because ultimately the more people watch Netflix, the more pricing ability they have, right? That's what drives the business in the long run. And I think that's why Netflix is really, there's 2 things here. Number one is, that's why Netflix is leaning so hard into things like sports and live content, where they have the NFL games on Christmas. They have the WWE deal.
Yeah, that's coming up in January. Yeah, pretty exciting for those who love wrestling.
Yep. And that's why they're investing in things like video games. It's because those are going to be the next legs of growth for the business going forward.
Yeah, I read today that Netflix is not going ahead with making their own AAA video game, but still, I guess, using other people's video games developers and selling them, or at least allowing their users to play them, and that will create more eyeballs, more content, hopefully selling more advertising.
Right. And so going into 2025, I think they've publicly said that. So to take a step back, in 2022, when things were starting to slow down, Netflix halted their content budget. They froze it and said, this is what we're going to spend while we fix the business. And now that the business is fixed, we have more money, and we're going to start investing. We're going to raise the content budget again. We're going to put it more back into content for the subscribers of Netflix. And so there's going to be less margin growth going forward, at least in 2025.
Yeah.
But in this case, the market doesn't care, because I think Netflix is clearly doing this from a power of strength, from a position of strength. Yeah. Especially where the competitors, and we'll talk more about this at the Outlook meeting, their competitors are in
that's a little hint for our webinar that we'll be doing on October 29th at 7 p.m. You can register for free on our website.
Their competitors are in complete shambles at this state, right? So for Netflix to really step on the gas a little bit, I think it makes a lot of sense.
Excellent coverage of Netflix. I hope you're watching, if you're a subscriber, at least 2 hours a day, and check out the video games that they have as well. A lot of fun. Ernest, have you looked at any video games on Netflix? I know you were a gamer. You're probably not such a gamer anymore, given.
I was never like a gamer.
Yeah.
Ben, who has been on this podcast a couple of times, he was the guy who was, I think he was a ranked player in League of Legends.
All right.
I was never. I have
not only is a great portfolio manager, but he's a great video gamer at League of Legends.
I have very poor hand-eye coordination.
Okay.
So gaming was not my thing.
I loved games when I was a kid, like the first Nintendo, but now the games are I'm too old and the games are way too advanced for me to figure out. You know, when my kids were older, 15, 16, they want, Dad, come play Call of Duty with me. I couldn't play it for more than a minute. First of all, the movement made me want to throw up. Second of all, I would get, shot in 2 seconds because I sucked at those games. So
can do a whole podcast on Netflix gaming strategy at one point.
So I think that's hopefully gives everybody a good understanding of the quarterly earnings game and what we think about when we're looking at the companies we want to own. Are they laying the groundwork for future growth? Are they making smart investments, smart capital allocation? Are they good? Is the business getting better or getting worse? If the business is getting worse and we don't see any way out of it, then probably it is time to sell. But I don't think for any of these companies that we talked about, CoStar, Moody's, Netflix, and TFI, I don't think long term their businesses are getting worse. I think they're all making the right investments for further strength into the long term, and hopefully they'll all deliver strong results going forward. So thank you very much. Our podcast is growing, and it's thanks to you. With the YouTube version, Spotify, Apple, we really appreciate all your feedback, all your support, and we'll see you back here real soon.